Hey everyone, welcome to episode one of our podcast. I'm Adam Vernon. This is my brother Jacob Vernon. We're both investment advisor representatives with our family's investment advisor firm, Vernon Management Group. And on this podcast, we're going to be talking about current financial topics, some retirement topics, and general market news. So I hope you enjoy.
So, for today's episode, we're going to talk about if you should be worried about the US dollar, inflation and interest rates, the difference between an investment plan and a financial plan, and how time affects return.
All right, so I want to start off talking about the US dollar. This is
Okay.
something that's been in the news a lot lately on a bunch of news channels. I've heard people are really concerned about it. And people are really worried about the US dollar being replaced, right?
Yeah.
Chinese currency or some other kind of currency coming in and taking over. So, what are your thoughts on it? You're pretty qualified to talk about it.
Well, that's a great question, Adam. When I think about this question and the US dollar potentially becoming weaker or, not kind of falling away from being the world currency, I think of this book I read this year by Ray Dalio called The Changing World Order. And kind of a short summary or what the book was about is it's about world powers and how a country becomes a world power, and especially how a country's currency becomes a reserve currency. And for many of you that don't know what a reserve currency is, basically it's the currency all other countries want to save in. So, as many of you know, a lot of countries save in the United States dollar, and that's because the US dollar is the reserve currency right now.
Okay, well that makes a lot of sense, Jacob, about, reserve currencies. But whenever I think about the US dollar, and I'm sure a lot of people are like this, it's like, oh yeah, the US dollar could never be bad. It's we're the greatest country in the world. Like the United States is an awesome economy. It's safe. And I understand what you're saying, but it's still like a little bit concerning. So, how often, or I guess a better way of saying it would be, how many years does it take for a reserve currency to fall out of that position and another one to overtake it?
So, I don't think there's a specific time period that you can put on, when will it end? When will a country stop being a world power? Because that has to do a lot about, with the country's situation. Before the United States, it was England. They were the reserve currency, and they were a reserve currency for, you know, almost 200 plus years. So before them, it was the Dutch. So, I think it's kind of based on the country's circumstances.
Mhm.
And then also, another country has to come and take its place. So if there's no competition, you're not going to see much of a shift. But if there is competition, and it's slow, it's not quick, someone can't just in 5 years, take its place, even 20. I mean, Britain, after they were not a world power anymore, the pound was still the reserve currency for like another 20 years after they lost their position of power before the United States US dollar took over.
Okay, so in really simple terms, you're saying that if people are worried about it right now, they shouldn't be, because most likely in their lifetime, or at least for a while, it's not really going to be a change.
Yeah, and what people don't realize is that the United States and I think it's the European Bank, the US dollar is 50% of its holdings. And the most likely right now that might take over as the reserve currency is China, because their indicators are pointing kind of strong towards that. But you never know. Stuff can happen. But China's only like around 2% of the holdings. And you're not going to see a drastic change in that, for a while. It may be incremental if the United States does lose its position of power, but you know, the bank can't switch that quickly. So that's what I would say to that.
Yeah, and just on that China point, I think, me included, but a lot of people think of China as kind of scary, competing with the US economy. So I guess what the worry is people think, oh, this is going to happen, immediately it's going to sneak up on me. But as you're saying, this is really incremental. So we're going to see it coming from a long way away.
Yeah. I mean, you may not see it coming, from a long way away. I don't think anyone can really predict exactly what will happen.
Hmm.
I think you'll probably experience it, I mean, I don't think it's going to be soon. Like, I think people are worried right now because inflation's high, but we've seen the US economy do really well this year in 2023. So, and inflation's down um, since last year. And if the Fed keeps doing its job, inflation's going to keep going down. And I think if that happens and, some other factors about the economy continuing to be, overall increase, then, I don't think in the next 5 years we're going to have anything to worry about, is what I'm trying to say.
Yeah. All right. Yeah, that makes a lot of sense. On that point, let's transition and start talking about inflation and interest rates and what to expect going forward. Jacob, inflation and interest rates have been in the news a lot the last 2 years,
Yeah.
and they've been a really, big topic of discussion.
Hmm.
Last year we saw really high inflation, and I want you to talk about why we saw that inflation because it relates back to, the COVID stimulus packages that were given out.
Yeah. So, the reason we saw high inflation and the reason inflation happens in general is because of supply and demand. So, if there is a low supply and high demand, meaning more people want something that there's not a lot of, more people are willing to bid up the price,
Yeah.
and that causes inflation. When there's a high supply and low demand, you see deflation because people have to lower their prices in order for their things to sell. That's kind of the gist of it. There's a lot more,
It's a
that
really simplified
yeah,
version.
yeah, that goes into why inflation happens. But when I think back and I think of COVID, I think of the stimulus packages
Yeah.
that were given out, and that caused a big flow of cash to go into consumers' pockets, and no one saved that money. I mean, most people I talk to spend it on something. They spend it on either their house or bought something they really wanted, and that caused, because no workers were working during COVID, there to be low supply of goods but high demand, which caused inflation.
So let's talk about that one point. How does spending versus saving affect how much inflation goes up?
So I don't know if we can actually, determine that, specifically,
Sure.
but kind of what I think about is if no one's spending the money,
Hmm.
um, then there's no reason for inflation to happen because there's not an extra demand for goods.
Okay.
And people thought, when COVID happened and all the stimulus package were going to given out, we were going to instantly see a drop in the market because inflation was going to hit. But what happens when there, you know, is a lot of money given out and people spend it all is equity prices go up. So,
Okay.
and that's kind of what we saw in 2020. And, for most of 2021 until the very end when people started to realize inflation, occurred.
So we started to see inflation come about
Yeah.
towards the end of 2021.
Yeah. And in 2022,
We had really high
we
inflation in
had really high
2022.
inflation. We had over 6%. And you saw a large drop in equities because of that.
Yeah, and that's also the Fed decided to start raising rates,
Well, the Fed decided to start raising rates because
because of the high
of the high
inflation.
inflation.
And if anybody doesn't know, the Federal Reserve is the also called the central bank, and they battle inflation by raising interest rates, right? Because if interest rates are higher, you're going to have less people borrowing money and less people spending money.
Yeah, and the Fed is also responsible for printing money, and they're really responsible for the overall economy,
Yeah.
right? They either try to weaken the economy to decrease inflation or for some other purpose, or they try to strengthen the economy. And like Adam was saying, a major way they try to do that is through interest rates. You saw in 2008 after the
The financial crisis,
financial crisis, interest rates were at zero. And look what,
which allows for a lot of borrowing. Right.
yeah, which allows for a lot of borrowing at little to no cost. And you saw the effects of that, and people say, well, why don't they just leave them at zero all the time? Well, that's because if they left them at zero, currently we'd probably be looking at a lot higher inflation than last year. But because they raised them
Hmm.
to, I don't know exactly what the rate is, but I know it's like 5.5 or higher percent. We've seen a decrease in inflation this year. I think it's a little above 3%. Um, so we'll see what it finishes up at the end of the year. But currently, the Fed just announced a rate pause as of September, and we'll see what their decision is the next time they have a meeting. I think, at least the news says that they might have one more rate hike this year and then pause it until, we see a reaction.
Yeah, you
Whether
mean
inflation,
pause raising rates or lowering
pause
rates.
raising rates until if we see that inflation is stable
Yeah.
and it starts to decrease, we'll likely see a lowering of rates. So, Adam, our third topic today is what is the difference between an investment plan and a financial plan?
Well, that's a really good question, Jacob. And a lot of people think a financial plan and an investment plan are the same thing. It's not really true. Actually, a lot of advisors will tell you it's the same thing. But a financial plan includes, your retirement savings, your expenses, and projects how much money you need when you do retire.
Gotcha.
Plus, the important part is it tells you the rate of return you need to make in order to achieve your retirement goals.
Okay. Well, how do you actually make that rate of return? Because financial plans just tell you, like you were saying.
Exactly.
So,
So an
is that
investment plan is going to tell you how to make that rate of return.
okay?
So say your financial plan says, "Oh, I need to make 8% a year in order to hit my goals." The
Okay.
investment plan says, "Okay, you need to invest in these assets and you'll have a good chance of hitting your goals." Obviously, nothing's guaranteed in the stock market,
Yeah.
but and then you need to have active management as well in your
Okay.
investment plan.
So, when you talk about active management, I feel like whenever I hear that, I think of almost like day trading. But what does active management actually mean?
Yeah, so an active management for a retirement plan, most likely not going to be day trading in stocks. You're going to have ETFs, what are exchange traded funds, bigger assets, right?
Okay.
And they're going to be traded not very often, but more often than a buy and hold strategy, right? So maybe once a month you
Once a
make a
month?
trade.
Okay. So you mentioned buy and hold strategies. Now, most people I talk to usually utilize some form of a buy and hold strategy. What do you think of that? Do you think people with a buy and hold strategy need an advisor, or is there a better way you could do it?
Jacob, a buy and hold strategy is good for some people, but for people who are in their 50s and 60s approaching retirement or at retirement age, a buy and hold strategy is actually not good, right?
Mm-hmm.
You need more active management. You've already made all your return. If you haven't made your return by the time you're at retirement age, you can't really retire, right? You're
Yeah.
not going to have that big money pool that you have worked on for most of your life, right?
Yeah.
So you want active management because you can be risk averse. So if a market starts to roll over, you can exit the market quickly and keep your capital safe. All right, everyone. So that's going to conclude our first podcast. Thanks so much for being with me today, Jacob.
Yeah. Thank you.
As always, like and subscribe and comment down below if you want more of this or any other topics you want us to talk about. And I'll see you in the next video. Thanks.